There are moments in the market cycle where valuation, income, and structural tailwinds align at the same time. And for publicly listed BDCs and for BDCI specifically, we believe we are in one of those moments right now, and let me try to explain why. The first part is the valuation opportunity. The publicly traded BDCs are currently traded at approximately 85 cents in the dollar, and this is a near decade-wide discount to net asset value. On a historical standard, the 10-year average is approximately 95 cents in the dollar, meaning the sector is pricing in significant more stress than underlying loan books actually reflect. The dislocation has been largely driven by sentiment, with negative headlines around non-traded BDC redemptions and isolated software credit concerns, rather than by widespread deterioration in credit quality. In Muzinich's view, the current valuation significantly overstates the underlying risk, and for disciplined long-term investors, the current near-decade-wide valuation discount is a compelling entry point, and not a reason to stay away. I'll talk about the structural tailwinds as well. The US base rates remain elevated, directly supporting wide spreads on floating rate private credit loans, as income is structurally higher than it was in the low rate era. The banks continue to retreat from middle market lending and increasing deal flow and pricing power for non-bank lenders like BDCs. The underwriting standards also have been tightening, meaning newly originated loans are of higher quality than loans originated in looser conditions ranging from 20 to 2022. And the recent private credit blowups have triggered a flight to quality, where the best-in-class BDCs are actively taking market share from weaker competitors. We think the macro setup with elevated rates, bank retrenchment, tighter underwriting, is as supportive for BDC income as it has been at any point in the past decades. What does it mean for yield? The Muzinich public BDC income strategy has delivered an average gross dividend yield of 9.8% per annum since its inception in July 2014 in US dollar terms. This is across multiple rate cycle and credit environments. The forecasted monthly distribution for BDCI is 17 cents per unit per month, which translates to an indicative annualized yield of approximately 10.2%. The distributions are paid monthly, generally within 20 business days of month end, and the income is not discretionary. The BDCs are required by US laws to distribute the 90% or more of their taxable income, which is what funds the BDCI dividends. And because the underlying loans are floating rate, income adjusted with US benchmark rates, providing a natural hedge in a higher for longer inflation environment. Lastly, I'll come back to the timing and why I think it's a good time to invest in BDCI now. For Australian investors, accessing this opportunity has historically required navigating offshore brokers, currency conversion, custodial arrangements, and minimum investment thresholds. And BDCI removes all of that friction as it trades on the ASX like any share or ETF, daily liquidity, and no lockup. It is the only way for Australian investors to access the opportunity in this simple format. A near decade-wide sector discount, a 10.2% indicative forward yield, daily liquidity, and active management from a 35-year global credit specialist.
To learn more about BDCI, get in touch with our team.